Days sales outstanding is the average number of days it takes a company to collect a customer receivable. In short, it's the amount of time it takes to collect a credit sale. Days sales outstanding is also called the average collection period, and it can be calculated by taking 365 and dividing it by the company's receivables turnover. If you're using quarterly data, you'd divide 90 by the company's receivables turnover. So how do you calculate receivables turnover? Well, it's equal to total credit sales divided by the average net accounts receivable. Note that I said the average net accounts receivable. This is the company's trade accounts receivable after subtracting the allowance for uncollectible accounts. Now, to find the average net accounts receivable, you just take the net accounts receivable from the beginning of the year and add that to the net accounts receivable at the end of the year and divide by 2. If you're using quarterly data, you'd add the net accounts receivable for all 4 quarters and then divide by 4. Now, to find total credit sales, you can usually just take the net sales figure from the company's income statement. Unfortunately, some companies report a single sales figure that includes both credit sales and cash sales. This can be an issue. If cash sales are a significant part of total sales, then using total sales instead of total credit sales can distort days sales outstanding. Fortunately, if the proportion of sales that are cash sales is fairly stable over time, then using total sales instead of total credit sales isn't that big of an issue when analyzing long-term trends in days sales outstanding. Now let's do an example of how to calculate days sales outstanding. Assume that a company reported total credit sales of $125 million for 2021. The company reported net accounts receivable of $35 million as of January 1st, 2021, and net accounts receivable of $15 million as of December 31st, 2021. Thus, its average net accounts receivable for 2021 was $25 million. Based on these figures, we can see that receivables turnover was 5. This means the company collects its receivables about 5 times a year. And now that we know receivables turnover, we can calculate days sales outstanding, which in this case is 73. This means it takes the company 73 days to collect its receivables. By the way, if you find that formula confusing, here's an alternative way to calculate days sales outstanding. You can simply divide the average net accounts receivable by the company's daily credit sales. In our previous example, the company reported total credit sales of $125 million for 2021, which means that its daily credit sales for 2021 were $342,465.75. We said that the average net accounts receivable for 2021 was $25 million, so plugging in these figures tells us that days sales outstanding is 73. Note that in all these examples, I used the average net accounts receivable. But in some cases, it might be better to use the ending balance of net accounts receivable. In his book, Financial Shenanigans, Howard Shillett notes that it's best to use the ending balance to calculate days sales outstanding if you believe the company is engaged in aggressive revenue recognition. But Shillett acknowledged that using the average balance is appropriate when assessing cash management trends, like a company's ability to manage its working capital. Thus, don't be surprised if you see someone using the ending net accounts receivable balance to calculate days sales outstanding. Finally, you should note that days sales outstanding and receivables turnover are inversely related. A low days sales outstanding means a high receivables turnover, but a high days sales outstanding means a low receivables turnover. A low days sales outstanding, or high turnover, is good for the company because it means it's collecting credit sales quickly. But a high days sales outstanding, or low turnover, is bad for the company because it means customers are slow to pay, or that some customers aren't paying at all. This means capital will be tied up in accounts receivable for longer, collection is less likely to occur, and an impairment might be required. In the videos to come, we'll talk more about why days sales outstanding matters and how companies can take steps to reduce it. Now, if you'd like to receive the PDF guide I used in creating this video, along with a days sales outstanding calculator and spreadsheet, just sign up for my email list using the link in the description section below. You can also receive the PDF guide and spreadsheet immediately by becoming a supporter on Patreon.